Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Voice.com.
Today, we're diving into three major stories. First up, the market seems to be shrugging off an 8% drop from Nvidia. So what's really going on? We'll look at how a stunning 283% surge from rival Broadcom reveals a massive power struggle is underway. Then we'll turn to PepsiCo. Activist investor Elliott Investment Management is targeting the company after a $40 billion market cap loss, and its long-running battle with Coca-Cola is right at the center of the drama. And finally, a bombshell report suggests OpenAI could burn through a staggering $115 billion. We'll uncover the real reason why and what its secret chip-making plan with Broadcom has to do with it. The US economy just posted a jobs report so weak, it's typically seen right before a recession. The market's biggest star, Nvidia, just tumbled 8%, and the hottest IPOs of the year have absolutely cratered, but somehow the bull market is refusing to die. Here's the damage report. The August jobs report came in at just 22,000, a third of what was forecast. As we discussed just a few days ago, this is precisely the kind of weak number the market was betting on to force the Fed's hand. Now, this isn't just a random blip. What most people aren't seeing is how the US labour force is being fundamentally reshaped. Between January and July of 2025 alone, over 1.2 million immigrants left the labour force, partly due to stricter policies. At the same time, the native-born workforce is shrinking as baby boomers retire. This creates a shadow labour force gap that makes traditional job numbers look weak, even when demand for workers is high. Nvidia, the undisputed engine of this market, cracked below its 50-day average. And that Nvidia drop, it's a much bigger deal than you might think, all because of something called concentration risk. Nvidia has become so massive that it makes up over 8% of the entire S&P 500's value. In fact, earlier this year, Nvidia alone was responsible for over 20% of the S&P 500's total gains. This means when Nvidia sneezes, the whole market, including your 401k, catches a cold. Bitcoin followed, dropping 10% from its recent peak, and those must-have initial public offerings. Stocks like Figma and Circle have been decimated, plunging between 40 and 60% from their post-pop highs. The significance of this is what experts are calling the Roman candle effect. These stocks shoot up with incredible hype on day one, and then they just burn out and fall back to earth. You see, there's often a huge disconnect between the inflated valuations these companies get in private and the harsh reality of the public market. Research on over 200 tech IPOs found that while most get a big first day pop, their average return after 1 year is actually negative 19%. The initial hype just doesn't last. So with all that blood in the water, the market must be in a freefall, right? Wrong. This daunting list of ills has barely made a dent. The S&P 500 remains up 10% for the year and is less than 1% away from a new all-time high. The story isn't about a market crash. It's about a massive power struggle happening in plain sight. As investors bailed on some leaders, they rushed into new ones. While Nvidia was falling, rival chipmaker Broadcom surged on a blowout earnings report. In fact, over the past 2 years, Broadcom's stock is up an incredible 283%, now outpacing Nvidia's own meteoric rise. We're witnessing a leadership rotation in real time, with Broadcom, Alphabet, and Apple taking the heavyweight mantle, but that's not the whole picture. This isn't just one stock replacing another. It's a fundamental shift in the AI industry. The market is betting that the future isn't just about selling powerful chips like Nvidia does. It's about creating entire ecosystems. Broadcom, for example, is now working directly with companies like OpenAI to develop custom in-house AI processors. The value is moving from the foundational chip maker to diversified players who can integrate hardware, software, and platforms. This resilience has Wall Street convinced the Federal Reserve will step in to cut interest rates. This reinforces the great paradox of the modern market we've discussed before. Investors are now trained to see bad economic news as good news for stocks. They're betting that any sign of weakness will force the Federal Reserve to cut interest rates, pumping cheap money into the system and pushing asset prices even higher. It's a market that is increasingly disconnected from the health of the real economy on Main Street. Even Bank of America economists just flipped their script, abandoning their prediction of no cuts this year and now penciling in 2. This all begs the ultimate question, especially given the deep internal divisions at the Fed we highlighted last week. Is the central bank about to cut rates to support a healthy, rotating market? Or are they hitting the panic button just in time to prevent a serious downturn? The answer will define the next chapter for everyone's money. And while Wall Street is focused on that high-stakes game between the Fed and the market, another kind of battle is brewing, this one involving a brand you see every day. An activist investor just dropped a $4 billion bombshell on one of the biggest brands in the world, PepsiCo. Before we even get into the details, you have to understand how these modern activists operate. When Elliott says it did extensive due diligence, it's not just a couple of analysts in a room. Here's a look behind the curtain. These firms use a sophisticated tech stack to build their case. We're talking about using alternative data sources like satellite imagery to monitor factory output or retail foot traffic, scraping credit card transaction data to see what people are actually buying, and even analyzing social media sentiment to gauge brand health. They use AI and machine learning to process all this information, building a picture of the company that can be more detailed than the company's own internal analytics. The target is on Pepsi's back after the company has lost almost $40 billion in market cap over the last 3 years. The activist Elliott Investment Management is pointing a finger at a series of strategic missteps that it says have caused the stock to lag its benchmark by a staggering 169 percentage points over 2 decades. And here's the killer fact at the center of it all: the battle with Coca-Cola. Years ago, Pepsi's beverage margins were actually 300 basis points higher than Coke's. Today, after a key strategic divergence in their bottling operations, Pepsi's margins are a jaw-dropping 1,000 basis points lower. This is where the situation takes a more complex turn because it's the core of the whole argument. Pepsi chose to own its bottlers, a strategy called vertical integration. The idea was to have total control over the supply chain and collect direct consumer data. In stark contrast, Coca-Cola stuck with a franchise model using independent bottlers. These partners have deep local market knowledge and can operate more efficiently. Coke focuses on the brand and the bottlers focus on execution, creating a cost-effective and flexible system that Pepsi's all-in-one approach just couldn't beat financially. But the rabbit hole goes deeper. Elliott's investigation found that Pepsi's North American beverage unit has 70% more products on the shelves than Coca-Cola, yet it generates 15% less in retail sales. This inventory bloat creates what's known as technical debt in the supply chain, and the consequences are pretty severe. Having all those extra products, or SKUs, means more frequent and costly changeovers on the manufacturing lines, more complex warehouse storage, and a nightmare for the software that tries to predict demand. It leads to higher costs, lower efficiency, and a greater risk of stockouts or overstocking. The diagnosis is a company that has overextended into weaker brands like Starry and SodaStream, while underinvesting in its core powerhouses like Mountain Dew and Pepsi Zero Sugar. Now, Elliott is coming in with a radical plan. They are pushing Pepsi to refranchise its bottling network, slash its bloated product lineup, and even consider divesting from an iconic brand sitting in the center of your grocery store, Quaker. And when they talk about divesting a brand like Quaker, this isn't just about a single year's profit and loss. Modern investors use advanced data analytics and predictive modeling. They look at metrics beyond the balance sheet, like supply chain synergies, how fast brand loyalty is decaying, or social media sentiment to truly decide if a brand is a non-core asset that's dragging the company down or one that's worth saving. The goal is to stop the financial bleeding and refocus on the core brands that built the empire. So the thing is, this back-to-basic strategy isn't just about nostalgia. In today's world, the beverage market is being disrupted by tech-driven startups. By reinvesting in powerhouse brands like Gatorade and Pepsi, the company can leverage its massive brand loyalty and distribution network as a powerful shield against these smaller, more agile competitors. And if you think this is just about a short-term stock pop, think again. In its 74-page presentation, Elliott uses the word reinvest 54 times and the word buyback 0 times. Elliott believes this overhaul could provide at least 50% upside to shareholders. This is a fundamental challenge to Pepsi's entire strategy, and it all begs the question, will the board of one of America's most iconic companies listen? It's a huge question of strategy for an established giant. And while Pepsi is being told to simplify and focus in the world of AI, the strategy is the exact opposite. Go big or go home. Believe it or not, OpenAI, the company behind ChatGPT, is now projected to burn through $115 billion by 2029. And if that number sounds wild, the full story is that it's $80 billion higher than the company's previous forecast. According to a bombshell report from The Information, the spending is accelerating at a dizzying pace. This isn't a slow burn, it's an explosion. The company is projected to burn through more than $8 billion this year alone. Next year, that figure is expected to more than double to over $17 billion. Then it gets even more extreme. A projected $35 billion burn in 2027, followed by $45 billion in 2028. What really brought this into perspective for me was that, according to their own projections, OpenAI doesn't expect to break even until 2029, and that's only if they can hit an astonishing $100 billion in revenue. This is a high risk, high reward bet on the future of AI itself. So what's fueling this financial firestorm? The astronomical cost of cloud servers needed to power its artificial intelligence. OpenAI has become one of the world's biggest renters of computing power from suppliers, including Oracle and Alphabet's Google Cloud, and the bill is coming due. This isn't just about paying a big bill, it's a strategic hedge. By working with Oracle and Google, OpenAI is intentionally diversifying its infrastructure. This helps them avoid being completely dependent on their primary investor, Microsoft, and its Azure cloud platform, giving them more independence and negotiating power. But the real hidden cost here isn't just measured in dollars, it's measured in power and water. Just think about this. The International Energy Agency reports that data centers and AI already accounted for 2% of global electricity demand back in 2022. By 2026, that's projected to equal the entire electricity consumption of Japan. And it's not just power. Research estimates that training a single model like GPT-3 can use up to 700,000 litres of clean fresh water for cooling. This is the staggering environmental price of our AI-powered future. But the rabbit hole goes deeper. To escape this cost spiral, OpenAI is making a massive high-stakes pivot. The company is now reportedly developing its own custom AI chips in a partnership with semiconductor giant Broadcom. It's also involved in the Stargate initiative, a potential $500 billion project with SoftBank to build its own data centers. Now, if this strategy sounds familiar, it should. This is the exact same playbook we saw from Alibaba, which is developing its own chips to create a competitive moat. It's a trend that's accelerating as major players realize that owning the silicon is key to controlling the AI ecosystem. Here's where it gets really interesting. This move to create custom chips is more than just a cost-saving measure. As we've discussed before, this is the captive silicon strategy. It's a play to become a full-stack AI provider by creating a closed ecosystem from the chip to the chatbot, tackling the huge long-term cost of inference, which can be 10 times more expensive than initial training. This is a direct challenge to Nvidia's market dominance and fundamentally changes the power dynamics in the AI industry. This isn't just about saving money, it's a battle for control over the future of AI. The company is betting billions to break its reliance on outside suppliers and build its own infrastructure from the ground up. Now, the sheer scale of this investment creates an enormous and perhaps worrying barrier to entry. If it costs over $100 billion and requires a private infrastructure rivaling that of a small nation just to compete at the highest level, it could effectively kill the dream of democratized open source AI. We could be looking at a future where this powerful technology is controlled by just a handful of giants. This all begs the question, is this the masterstroke that secures OpenAI's dominance, or are we witnessing the prelude to the most expensive technological collapse in history?
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.